unsustainably, then it can create a financial bubble.
Ever wondered how the rich and famous always seem to profit during booms and avoid the busts? It's all about spotting those economic bubbles before they burst. From the wild tulip mania to the explosive dot-com bubble, and even today's everything bubble, these patterns are repeating. If you don't act fast, you could be left watching others make a fortune while your investments crash. Don't let FOMO take over. Learn how to spot the signs of market crashes and protect your assets from disaster. Don't wait until it's too late. Start making smarter choices today. Economic bubbles. An economic bubble occurs when the price of assets rises far beyond their intrinsic value, driven by irrational behavior. One of the most famous examples was the tulip mania of 1637 in the Netherlands, where tulip bulbs were sold at prices greater than the cost of a house. In modern times, the dot-com bubble of 1999 to 2000 became a notorious event, fueled by overconfidence in internet companies. Investors flocked to tech stocks, ignoring fundamentals. The 2008 global financial crisis was another bubble, where housing prices surged dramatically before crashing. Celebrities like Kylie Jenner and Elon Musk have had their own brushes with economic bubbles, often affected by market trends. Recognizing these bubbles is crucial to avoid financial disaster. Spotting signs. Economic bubbles don't form overnight. There are key signs that can indicate the presence of one. First, there's the rapid price increase of an asset, often driven by speculation rather than intrinsic value. This was evident during the 2008 housing bubble, where home prices escalated beyond reasonable expectations. Another indicator is the overconfidence of investors, believing that prices will keep rising. Celebrities like Kim Kardashian have been linked to trends that often reflect broader market speculation. As the 2000 dot-com bubble showed, when enthusiasm overtakes rational thinking, a bubble is forming, and its burst is inevitable. Recognizing these signs early can help investors avoid devastating losses. Monetary policy. Monetary policy plays a significant role in fueling economic bubbles. Central banks, like the Federal Reserve, influence interest rates and the money supply, which can cause asset prices to inflate. In the 2008 housing bubble, low interest rates made borrowing easier, leading to excessive lending and risky investments. This created an environment where people were buying homes they couldn't afford. Similarly, during the dot-com bubble, easy credit encouraged investment in technology stocks, even if the companies didn't have solid business plans. Celebrities like Oprah Winfrey have seen how economic shifts impact their investments. Understanding monetary policy can help investors recognize the early stages of a potential market crash. Psychology. Investor psychology plays a critical role in economic bubbles. Often, emotions like greed and fear drive market behavior. During the dot-com bubble, many investors became irrationally optimistic, pouring money into tech stocks without considering the fundamentals. The housing bubble of 2008 was driven by a similar psychology. People believed home prices would only go up, ignoring warnings of an eventual crash. Celebrities like Kanye West have expressed how market trends influence their business decisions. When optimism turns into euphoria and people stop questioning high valuations, it's a sign that a bubble is forming. Understanding these psychological factors can help investors avoid the same fate. Dot-com bubble. The dot-com bubble of 1999 to 2000 remains one of the most significant economic events in history. During this time, investors poured massive amounts of money into internet companies, often with little regard for the company's profitability. As stock prices soared, many believed the tech boom would never end. However, by 2001, the bubble burst, wiping out billions in investments. Celebrities like Richard Branson were caught up in the excitement of the tech frenzy, investing in online ventures that eventually collapsed. The crash left many investors in financial ruin, highlighting the dangers of speculative bubbles. The dot-com bubble serves as a crucial lesson in market behavior and caution. Everything bubble. The everything bubble, spanning 2020 to 2021, saw a massive surge in asset prices across nearly all sectors, from real estate to technology stocks. The COVID-19 pandemic led to unprecedented government stimulus measures and ultra-low interest rates, creating an environment ripe for speculation. People invested heavily in everything from stocks to cryptocurrency, despite many assets being overvalued. Celebrities like Elon Musk were directly linked to this boom, with his tweets influencing stock prices of companies like Tesla. However, just as quickly as the bubble grew, signs of instability emerged, raising concerns about an impending crash. The everything bubble serves as a reminder that even broad market booms can be unsustainable. Forecasting crashes. Forecasting market crashes is challenging, but certain models can help predict the likelihood of an economic bubble bursting. One such method is the CAPE ratio, cyclically adjusted price to earnings, which compares stock prices to long-term earnings trends. During the 2008 housing crash, indicators like over-leveraging and unsustainable home prices signaled a looming collapse. Similarly, in the dot-com bubble, the overvaluation of tech stocks became apparent to experts. Celebrities like Warren Buffett have consistently warned about overpriced assets. While no prediction is perfect, recognizing key warning signs can help mitigate the risks of a crash and provide early signals to investors. Investor strategies. Navigating through economic bubbles requires careful strategy. One approach is diversification, spreading investments across different asset classes to minimize risks. During the 2008 financial crisis, many investors who relied too heavily on real estate or stock markets saw huge losses. Another key strategy is staying informed and sticking to a long-term investment plan, avoiding the temptation to follow short-term trends. Celebrities like Mark Cuban have stressed the importance of doing your own research rather than getting caught up in speculative hype. Finally, maintaining liquidity and having an exit plan in case the bubble bursts can protect investors during uncertain times. Tech booms. Technological booms often drive economic bubbles, with investors betting on new disruptive technologies. The dot-com bubble was a perfect example, where the internet and tech companies saw their stock prices soar, despite many lacking profitable business models. In recent years, AI and cryptocurrency have fueled new bubbles, with celebrities like Elon Musk and Jack Dorsey publicly backing these sectors. However, these markets have shown volatility, as seen when Bitcoin prices surged and then fell dramatically. Understanding the potential for overvaluation in tech markets is crucial. Investors must remain cautious and avoid following the hype without considering the actual value of these technologies. Policy measures to prevent future economic bubbles. Policymakers can implement measures to stabilize markets. One of the most effective tools is regulating interest rates to avoid excessive borrowing and speculation. In the aftermath of the 2008 financial crisis, central banks took steps to introduce stricter lending regulations, aiming to prevent a repeat of the housing market collapse. Governments can also promote transparency in financial reporting to help investors make informed decisions. Celebrities like Bill Gates have often advocated for more regulation in technology sectors to avoid market manipulation. By enforcing regulations and improving market oversight, policymakers can reduce the likelihood of bubbles forming and protect investors from severe crashes. Feel like you're missing out on vital financial knowledge? You're not alone. Join us in our next video, Alternative Assets, Profiting from Art, Wine, and Rare Collectibles, and uncover how savvy investors are making huge returns from unique, high-value assets. Don't miss the chance to stay ahead of the game. Subscribe now, hit the bell icon, and be the first to know about exclusive tips and strategies. Don't let FOMO control your investments, take charge, and be part of the next big wave.